good evening to this very interesting event with Marc Sugarman. This is the last of our annual wealth management lecture series. I'm pleased to have Marc Sugarman here as my guest. Marc is a very prolific speaker. He's got a long track record as an analyst with Morgan Stanley, Goldman Sachs, and then Citibank. Also at Citibank, but our ways unfortunately will cross over there maybe later. And he's now a director at two asset management companies, Blue and White Capital and Star Lizard. And more importantly, he's also a director at Brighton and Hove Football Club. And we're looking forward to his talk about values and valuations in the stock market and in football. Thank you very much. So over to you. Thank you.
Thank you. Thanks for having me, Greg. It's a real pleasure to be here. This is going to be very informal, so if you've got questions as I'm talking, please chip in. What I thought I'd do is just talk about some of my history, and then try and sort of talk about values and valuation as we go, with the different sort of career paths that I've had the fortune of being involved with. So my main career for 17 odd years, when I worked at the US investment banks that Jacob mentioned, was as a media analyst covering equities. And what's quite interesting about that is that the media sector is quite a broad spectrum. So you had on the one hand educational publishers, business publishers and so on, legal publishers, the likes of Reed Elsevier, Wolters Kluwer and so on. And then you had Sky, B-Sky-B, Vivendi, you had EMI music companies, so it's quite a broad mix. And I think because of that, you get a real sense of what the values, what the brand actually stands for each of those companies, and how that affected valuation for those companies. So what I thought I'd do in this sort of first part of the presentation is just talk about two or three of those companies and explain what they stood for and then how that affected the perception the market had of those stocks. Things have moved on, by the way, a great deal since I left, because I left about 10 years ago, something like that. But at the time, one of the most interesting stocks, I think, was Sky. It's probably the stock I enjoyed covering the most, because there was such a pull and push, depending on whether you were bullish or bearish on the stock, on what the valuation should be. If you were bullish, you would point to the free cash flow or the potential free cash flow. If you were bearish, you would talk about over-the-top risks, the fact that the business model was going to change. So just let me talk a little bit about those two ends of the spectrum, if you like. On the bullish side, this is a company which, values-wise, stood for excellence and stood for investment. So Sky basically came in, and they should never have had a chance to really start up. ITV could have called them a birth. They ended up buying the football rights quite cheaply in the early 90s, building up a subscriber base on the back of it. Then, because people are quite lazy, the subscribers didn't churn as much as the market thought, and then they added a lot of new features because of TMT and convergence, which drove sub numbers, and then their free cash flow sort of just started to build and build and build. So you had a situation where they never quite delivered on margins. Margins were around sort of mid-teens, something like that. But you could have expected the margins to be near 30%. So they were trading mid-teen margins, but they could have been 30%. But what they did, and this is where the value side of it comes in, is they just continued to invest. They were a real top-line type company. You know, their companies are either sort of cost cutters or they're investors. And Sky was the ultimate investor in the media sector. So they invested in technology, they invested in content, and they invested in marketing. And that's why the margins stayed quite low. And what it meant was that if you were bull on the stock, you would just say, well, the margins are going to come through eventually. They're just building their sub-base. Whereas if you were bear on the stock, you would say, well, they need to invest, because at some point the content that they own is just going to be taken away from them, and the technology is going to catch up. And I think that Sky ultimately, I mean, I was a bear on the stock at certain times and a bull on the stock at other times, but ultimately what happened was, because the pressures of over the top came to hit the whole of the media sector. And what I mean by that is that you don't need the bundle anymore. So rather than buying a big pay TV bundle, you can just have like free TV, or you could subscribe to Netflix, which is pretty cheap or whatever, which you couldn't do 20 years ago, but now you can. And you can, a lot of people will pirate sports. So the one sort of glue that they really had, football, was not quite as sticky as people thought it might be. And so, you know, you could have been quite bearish on the stock, but what happened ultimately is that, you know, Comcast and a Disney, both of which were suitors for Sky, their problems were even greater, so they desperately needed the content. So all the kind of discussions around cash flow generation and valuation that led to, ultimately what actually happened was that they were taken out for a very, very healthy multiple. So that was a case of excellent values, you know, real top-line focus, investment focus, leading ultimately to the prize, which was you created a franchise which somebody else really wanted to buy. At the other end of the scale, and this is really not the fault of the company, but was just the fault of the area of the media sector they were in, would have been a Trinity Mirror. So Trinity Mirror, which is both a national newspaper company and a daily and a local newspaper company, the vast bulk of its advertising was classified advertising. Now, classified advertising back 25 years ago was newspaper, it was the domain of a newspaper. As technology evolved, it's perfect for online. Think about auto advertising, recruitment, etc. It all migrated online. And the mistake the likes of Trinity Mirror made is they didn't invest. They didn't invest online, they didn't build a property online, and therefore specialists came in and just took the market away from them. Hulu, for example, sorry, not Hulu, the Rightmove and some of the other online estate agents just sort of killed their market. And the result was that quarter after quarter of reporting for Trinity Mirror, they would have write-downs, they would restructure their business, their margins would kind of stay on a reported basis reasonably high, but that's just because they were restructuring all the time. The top line was never growing, and ultimately the stock didn't perform for that reason. So again, talking back to values rather than valuation for a second, if you're a cost cutter, and if you don't have a vision for the future, ultimately, the stock market will punish you for that. Whereas if you've got a vision, you're willing to invest, then you have a chance. Final company I talk about, which is was kind of in the middle, had a chance but didn't make it work, is EMI, which is a music company. There's a music producer and a publisher, and it had a great opportunity. The market was very divided on EMI for quite a long time. On the one hand, the kind of bears took the view that the album was this sort of artificial construct, and people were paying for sort of 10 tracks when they really only wanted one, and therefore they were being screwed by the company. The other kind of view, the more bullish view, was that the handheld devices, so smartphones and so on, meant that purchasing music could become ubiquitous. Anywhere you were in the world, you could purchase music. So there was a big debate on the stock. Ultimately, I think what happened was the ubiquity of purchase extended to TV content, which hadn't been the case in the past when you had the Walkman, and that's what killed EMI's business. But again, I think if they'd have been smarter and they'd have combined with another content house, they could have benefited over time from some of the developments that we're now seeing with Spotify and so on. But they just weren't. They didn't have the vision for that. I think Sky's management running EMI would have done a far better job. So that's the sort of media space. I just leave you with that. I'll say a little word about valuation per se and kind of a view on values on the media sector before moving on to some of the other things I've been involved with. My sector, the media sector, we really had very little in the way of assets. So the real valuation was always about cash generation. And I know Jacob just said that you've been to see Goldman. So Goldman, when I was there, they had this valuation methodology, which is quite unusual. I don't know if you've heard of it, but it's cash return on cash invested relative to invested capital. And basically what they were saying was, if you look at cash return on cash invested, where you need to do a lot of accounting to sort of strip out any non-cash type accounting that goes on in the financial statements. If you compare that to invested capital, the relationship should be pretty similar to your WACC relative to the EV of the company. So, for example, if you've got a company which does 20% cash return on cash invested, and does say 10%, has a 10% WACC, weighted average cost of capital, then you would expect that the EV, the relationship between EV and the invested capital would be similar. So EV should be twice invested capital, because you're getting twice the return on your cost of capital. And that valuation methodology was the best way to value my stocks, to value the stocks in my sector. I don't think it necessarily always works in asset-heavy sectors, but I think for a lot of sectors, technology sectors as well, that's quite a good way to think about things, because if the market is undervaluing EV, then undervaluing EV relative to invested capital based on the return, the return you can get on your cash. That's a good buying opportunity. Of course, ultimately, with the stock market and with all things to do with valuation, the most important thing is having a good view on the industry, understanding the fundamentals of the industry. Is this industry, because almost all industries have got some sort of technology risk, is this industry going to get shafted at some point because of a change in technology? And of course, Buffett takes the view that he doesn't want to invest in technology related areas because he just can't. He knows that he can't. He's not as good as technology analyst, and just can't call the future of technology as well as he can more sort of utility areas. And I think that's another lesson, which is always to sort of focus on where your strengths are. But understanding the future, and again, the media sector is a great example of this. When I joined the media sector in '97, it was around 8% of the market of the FTSE 100. Sorry, the FTSE All Share. At the peak of the TMT boom, it was about 12.5%. By the time I left in 2009, it was 1.5%. It just got destroyed by technology changes. And so I think particularly for non-asset type sectors, understanding the technology, so understanding, is this company going to be here in 100 years? Is it going to be here in 10 years? That's probably the first question you need to ask on the fundamentals. What is the sort of competitive dynamic of the company? And I think a lot of sort of investors who don't necessarily do the fundamental work, they get carried away by the herd, the sort of market mood at the time. And that's a very dangerous situation. So I'd always advise you to do the fundamental work. Okay, I'll move on now to football, because I think people like to talk about football. So Brighton Hove Albion, Premiership team, 21 points from 15 games, doing okay. I think we look at each season, at the start of the season, and our goal is to stay up, because it's so difficult in the Premier League. You've got 6 teams who are just way above everyone else in terms of what they spend. You then have another 3 or 4 teams, the likes of Everton and Leicester and so on, who again got far deeper pockets than we have. So you're already down to sort of half the league, where you're thinking, maybe we could expect at home to beat 10 teams in the league and get the odd point here and there. So it's really tough. So what does it mean in terms of trying? What do you have to do to outperform in football to stay up each year in the Premier League? And I think there's 2 things that we really focus on as a board of directors. One is infrastructure spend. We're lucky in Brighton in that we have a lovely city. We have a very big catchment area. I mean, Brighton, I don't know if you know this, has probably got even though south of us is the sea, we have the largest catchment area of any football club in the UK until you sort of hit the next team. And you think about it, the next team is sort of Crawley and Gillingham and so on. So we have a very big advantage being a one-club city, one-club county. But how do you exploit that? Or how do you exploit's not the right word. How do you make the most of that asset? And it is to create facilities. So you know, the difference between a player coming to a city where he may not be that attracted to live versus coming to Brighton is that not only is it a lovely city, but we've built an outstanding training facility, and the players day in day out they're at the training facility. That's their office. That's where they go each day, and we've got an outstanding stadium, and that's where the fans go. So we try and invest as much as we can on infrastructure to give the players a chance to be that little bit better than they otherwise would be. So the first instance is to attract them, and the second instance is, you know, to build cryo chambers and whatever the latest technology is for them to get the most out of their bodies, that they can be slightly better than they otherwise would be. So they fly to away games now, and it's worth spending, and they've got a luxury coach, so it's worth spending that extra money so that when they get there, they're going to perform absolutely at the top of their game. So all of these things, the investment, again, back to the Sky, what I was saying about Sky, investing for the long term, investing in the infrastructure is absolutely key. The other thing, the other key value, or the other key brand that we have is called Together. So our tagline is Together. Together in the Premier League, together before that in the Championship. And where this came from is the history of the club, because the club had a very difficult history. It basically almost went out of the league in the late 90s, so in the early 90s, when we had, in the mid-90s, we had our ground stolen from us from an owner, sort of three owners back. They asset stripped the club, so they sold our old ground, the Goldstone ground, and then rather than reinvesting in a new stadium, they just took the proceeds and ran. And the club was penniless for a long time, and had to beg, steal and borrow every which way. And as a result of that, basically finished penultimate in the what is now League Two, and just avoided going down. And avoided going down by winning at home the last ever game in the Goldstone, and then drawing away at at Newcastle in the last ever game in that league, which meant that we pipped Hereford. So Hereford went out of the league and we stayed up. So we had that history. And then we had a 10-year battle to get planning permission to actually build a new stadium. And ultimately, there were marches on Downing Street led by Des Lynam, who's a big fan of the football club. There were letters to the Vice Prime Minister, to the Deputy Prime Minister, and so on. And ultimately, we got planning permission, and we were very lucky, because if we'd have got planning permission earlier, we wouldn't have had the funds to build the stadium. As it happened, the guy who now owns it is a chap called Tony Bloom. He started to do quite well, and then by the time the planning permission came along, he had to get some money. So it worked out quite well. But again, when we got the planning permission, we were able to build something quite outstanding. So if you ever have a chance to come to the stadium, it's on the South Downs, which is an area of outstanding natural beauty, and it's a lovely, lovely stadium. So again, it's about the infrastructure. The Together bit comes a bit from the history. And there's an organisation called Fans United, and Brighton was the first team which Fans United backed. So fans flew in from all over the world, from Germany and so on, to march with us to Downing Street, to present John Prescott, then Deputy Prime Minister, with this petition to allow us to have a ground. It was very amazingly emotional times for everyone involved in the club, and ultimately we got there. So we had that history, and unfortunately we've had some very sad history more recently. The Shaw Mare disaster, which cost people their lives. And again, from that, this tagline Together. The end of that season, we had a match against Middlesbrough, up at Middlesbrough, the last game of the season. And if we'd have won, we'd have been promoted. And we drew. And we drew with what I thought was a shocking refereeing decision by the referee, a chap called Mark Dean, who you've probably heard of, who gave a red card to Dale Stevens, our midfielder. He was going to get a yellow card out, and the Middlesbrough midfielder had a massive gash on his leg, and he pointed to his leg, made him put his yellow card in when he took a red card out, which was totally ridiculous. And so Dale went off. We had momentum. We probably would have gone on to win. We didn't win. We drew. But that again, that experience of getting so close and then failing, led to this kind of togetherness at the club. And we were the first club to have a bonus scheme for all employees, not just the football players. And just again to bring that sense of togetherness, so that everyone at the club is pushing hard and pulling as hard as they can together, to ensure that Every fan has a great customer experience to ensure that if they want to spend money with us, they can do so, and to make sure that the players get to the ground at the right time and in the right frame of mind, etc. Everyone has a contribution to make, and that togetherness, I think in football, for a family club like ours, is really powerful. So again, I think valuation, keeping us in the Prem, and ultimately, if you're not in the Prem, and this is an interesting stat for you, or interesting thing for you to be aware of, the Championship is the worst division to be in financially, because everyone's trying to get into the Prem. If you look at the teams in the Championship now, they're phenomenal franchises. You know, Leeds, Sheffield United, Sheffield Wednesday, Swansea, Stoke, all teams that have been really in the big time. Derby, Aston Villa, and they're all fighting very hard, and they're all going to lose 25 to 30 million pound in the Championship, and their TV rights in the Championship are about £2.5 million. The TV rights in the Premiership minimum about £110 million. So you've half a chance of making a bit of money in the Prem, and then recycling it to sort of create a better product for your fans. So that the network investment and the brand and keeping true to your values. We had one incident at the club where one of the senior people at the club, I won't say who it was, behaved very discourteously, very badly, shouting match and so on. And most clubs would have sort of paid them a big amount of compensation just to go away. And we suspended them, and we had an investigation, and we actually ultimately removed them for gross misconduct, which most clubs would never have done because it was too much hassle. But again, we just felt doing things the right way and showing that we just won't accept, no matter who it is at the club, people treating each other with disrespect was I think a big statement. And I think that value, that togetherness, and the fact that we treat each other properly, treat people properly, has stood us in good stead now that we're doing fairly well in the Premier League. There's one other thing I wanted to say about Brighton. It'll probably come back soon. The other part about Brighton, which I just want to mention as well, is the community scheme. And I think, again, in life, whichever company you work for, there is a responsibility to give back, and football was able to do it, and as a duty to do it more than most industries, because the power of football means that you can reach more deprived areas of the city, the county, and people in difficulties than many other industries can. And to give you a couple of examples, Albion in the Community, which is Brighton's community scheme, which is outstanding, by the way. It's won 3 of the last 4 years, the best community scheme in the UK. Albion in the Community goes into about 150 schools in Sussex and teaches things like maths. And why maths? Because a lot of kids turn off when they hear about maths. You know, they find it difficult, it's not their skill set, they're not interested, etc. But when they hear about football, they are interested. So when you present a league table and you explain there's 3 points for a win, a point for a draw, and so on, and there's a goal difference in it, so you could start to give them concepts of arithmetic. So you can teach them maths through football, the power of football. And that's true. You can use geography. You know, you're travelling to an away game, Brighton against Liverpool, takes 2 hours on the train from London. You know, how many trains you get. All these types of things you can do through football, and kids relate to that. So we do that. We have a big disability football product as well for all types of disabilities, blind football, people with handicaps and so on. And it just means that parts of the population, the community, who would otherwise be fairly isolated, get brought in. And it's for a lot of these kids and adults, it's their life. And again, giving back to the community, I think is something that wherever you work, it should be a core value. CSR should be something which all companies engage with. And I think, largely speaking, the ones I've worked for have. I do want to go back actually to the 3 companies I worked for in the stock market, and then I'll get on to talking a little bit about where I am now. So the 3 companies, they probably to you, they just sound like big US investment banks, right? Just the same. They couldn't have been more different culturally. So Morgan Stanley, late 90s, they cultivated the personality of the analyst. So they had, their internet analyst at the time was a lady called Mary Meeker. Mary Meeker was like a god. When she was she was a celebrity. She had a fireside chat with Jeff Bezos, and it was difficult at the time to know whether Jeff Bezos was more important or Mary Meeker. She was that important. The cultivation of the personality of the analyst was shocking, because I was a young guy, came into the stock market, aged 23, 24, whatever, working for one of these people, and I won't say who it was, but they had a sort of a massive ego and just made my life totally miserable. And it was a horrible place to be for someone young. There was no team ethic. Then I went to Goldman. Goldman was phenomenal. Everyone thinks that Goldman's a tough place to be, and so on. I don't know whether the culture's changed. I've been there for 20 years plus. But at the time, their striving for excellence was something wonderful. I mean, it's really inspiring to try and be better than everyone else and just do absolutely best at everyone again pulling together. And when your team's doing well, we had a great couple of years in the media sector. We came top in a few surveys and so on. The support we had from management was enormous and wonderful, and that was a great time. And then Citigroup, which is a sort of a mix of, it's a bit more of a gentlemanly place, a bit more sort of kind of English, a bit more waspy, I guess, for want of a better term, and a better balance of work-life, which for a lot of people is really, and it is really important. So I think there's a time for everything in life, right? But the Goldman experience, I would advocate, and I would recommend for all of you who have a chance to work for a company which is totally outstanding and just wants to be the best in the world. You should take that chance, even if it's hard work for a few years. But then there's a balance when you have a family, you get a bit older, you want to have a bit more life. So now, where am I now? I run a family office, single family office called Blue and White Capital. Blue and White's because of the football club and various other reasons. We have three values: patience, excellence, trust. And the interesting thing about those values is that religious people look at values and so on. Religion, one particular religion I'm close to, the three sort of founding people of the religion, there are three values. One is kindness, one is personal discipline, and one is truth. And that balance, if you think about patience, excellence, trust, is very similar. Because one of those values, kindness, is really patience. It's how you treat each other. One of them, personal discipline, is excellence. And then the final one, truth, is trust. And I think most companies, when you sort of look at their values in that way, you need to have a balance. You need to have a balance between the kindness and the sort of desire to excel. And also honesty, I think, above everything, transparency. You see that with the current mess of Brexit, is something which everyone really values. And I think, again, when companies stand by their principles and their values day in, day out, it does affect the way investors see those companies. And I think those companies get a sort of halo effect on their valuation. And it's very easy to lose that. You can lose it so quickly. Now I run a family office, and we invest in private equity, in equities, in some property. Private equity, we invest in funds, we don't invest in individual deals. We recognize that we just don't have the expertise or the bandwidth to really look at individual deals in enough detail. So we're happy to be invested in funds. And we prefer private equity to other asset classes, mainly because we believe the consistency of performance among fund managers is greater. So that you can get equity managers, and there are some equity managers that are totally outstanding. They do year in, year out, tend to perform pretty well. But the variability in the top quartile of fund managers in the equity industry, we think, is quite significant. It's big variability. Whereas in the private equity space, we don't think it's so varied. And we found maybe a couple of handfuls of private equity funds which we're happy to invest in, year out. And what is great about private equity when you start to build a portfolio is the cash, because your commitments, you have a 3-4 year commitment in private equity, they tend to call maybe 75% of the capital commitment. But once you're sort of 4 or 5 years into it, you start to get the distributions from the earlier funds. So you then start to see that your actual cash, your net cash invested, is quite a lot lower than you first think, because the earlier funds start to throw off cash quite quickly if they're good funds. And then you can compare your net cash to the net asset value that the fund managers are quoting. And I think it's good, for us looking at other asset classes, private equity tends to be the best. And then Star Lizard is a consultancy, sports data consultancy. Got a myriad of different clients. The interesting thing about sports data is that the disciplines involved are quite similar to financial services. You need research, you need quant-based people who've got statistical skills, and you need a sort of an overarching person who understands sport and understands maths. You can then sell that product to clients effectively. So it's pretty similar, and the great thing about it is kind of similar to, I guess, working in the media sector, which is a fun space, is that people love to work with sports data. So I'm very lucky that I work with sports data on one hand, I work for a football club on the other hand. Having said all that, there's always challenges, it's always difficult. I mean, this week has been a total nightmare, yeah, it's good. Okay, I talked for a long time. Yeah, any questions?
Any questions? No? No questions?
This was a slightly cynical question, but because I've had clients who invest in football clubs, is it really possible to make money investing in football?
No. Don't invest in football. I mean, the owner of our football club is a fan. I mean, he's been a fan since he was born. His grandfather was actually vice chairman. Sadly, his grandfather died on the coach of it in an away game. I mean, they love their club forever. But you don't have to lose money if you do it right. But I remember the other thing I was going to say about the football club. As well as the infrastructure investment, the key thing is to really understand footballers and understand football, understand what you need. Because the transfer market, particularly in the Premier League, a cheap player these days is 15, 20 million pounds. This is a lot of money. An expensive player is 50 million pounds. So, and a very expensive player will be 100 million pounds. So you need to really know, what you're buying. And we've bought, I think, really well. And you need to take a view on, if you buy young players who aren't quite established, you probably pay a lot less, but you're taking a bit of a risk. So that's where we've tended to, certainly the last season, we've spent most of our money in that area. So we bought, over the summer period, we bought a lot of players, but two players in particular. We bought Bernardo, left back from Brazil, who's 20 years of age, phenomenally fast, very tall, going to be a great player. And we bought Bissouma. He's a Malian guy, he's a midfielder, he's phenomenally talented. And there's a great chant as well, which is tequila, which we all sing, so it's one of the best chants in the Premier League. But so I think having a fantastic recruitment analyst, and again, I think with any business, knowing what is the most important role in your business, because ultimately, you want to be kind to everyone, but there are one or two people in your firm who totally make the difference, and a recruitment analyst in a football club is so important. But yeah, back to your question. You can make money, but it's sort of the bigger fool argument, right? So they're trophy assets, and at some stage somebody might come along and want to, if you're Sinatra or whatever the guy's name was at Man City, and someone from Abu Dhabi wants to come and buy and pay a lot of money, then fine, you've done well. I don't think we'll ever sell. I don't think Tony will ever sell because he loves the football club. But if someone came along with a crazy offer, you may have to think about it for a few years. But he bought another. I said no. He did buy another club quite recently, which is purely a financial investment. It's a company. It's a club called RUSG, Royal Union Saint-Gilloise, which is in the Belgium second division, and bought it because it has a sweetheart deal from the council. So it hasn't invested in its own infrastructure, but it pays peppercorn rent for the stadium and for training facilities. And again, we believe because we think we're good at recruitment, we can buy young players who couldn't get into the Brighton team, but could get into our USG. If we can get them promoted, then in time that franchise can become quite valuable. So I think it is probably just about possible, but it's not easy. And for the most part, when you're buying an established team like a Premier League team, you know, you're just hoping that there's someone else wants to spend a lot of money without really worrying about valuation.
You mentioned that private equity, you think is a better investment compared to sort of other equities, so standard equities. I was wondering if you could elaborate on why you think it's a better investment.
Yeah, most of it is about the cash.
Okay.
So if you find the right fund manager of private equity, that, as I say, their returns tend to be relatively consistent over time. So you can model out quite well the profile of the kind of drawdown, the capital commitment versus the distributions. So on an average private equity sort of situation, there may be 3-4 years of kind of, you know, spending the capital, and then another maybe 4 or 5 years after that where the cash comes back to you. So if you model that, and it can, I mean, for a good fund, on average they'll be generating 2 times return over that period. So if you know, if they're calling 75% of the commitment, which is usually what they do, then you can work out pretty much what your cash generation will be in years kind of 3.5 through to year 8. And then you know, once that cash is coming back in, you can then figure out how much you can invest in to sort of continue. So it becomes years 2, 3, 4 are quite heavy. So 1, 2, 3 are quite heavy investment years. But then when they start, so you have the cash side of it. So your net investment ends up being a bit less than you first think. I think that's the main. With equities, I do think you can do very well. I mean, you know, look at we're in a 10-year bull market, right? I mean, for sure, you know, you can do really well in the equity space, and there are some phenomenal investors. I mentioned Berkshire Hathaway in the UK. You know, there's Lansdowne and hedge funds and long-only funds who are phenomenal. But I just think that the risk reward on private equity, because of what I've said about the cash point, is a bit more predictable. But it needs to be the right private equity fund.
Do you have a preference over smaller versus larger managers? Do you think that smaller managers are more nimble, they can go for the better deals, or do you need to be with a larger manager because he can just really, he's got the infrastructure, he's got the firepower?
The main,
or do you invest into both? Or?
The main kind of difference that we look at is secondaries. So we tend to invest. Yeah, we tend to invest more in secondaries, private equity,
Yeah.
because what tends to happen is that you get towards the end of a fund life, and the primary managers don't want to be holding this these investments because they want to be raising money for the next fund. So if they can sell out to a secondary fund willing to buy the sort of fag ends of their commitment of their fund, it then releases them to raise the next fund. They can make more money, and you end up getting quite a hefty discount. And if you do that well, and there, I mean, your question about big or small, the least competitive space tends to be the smaller end of that market.
Yeah, sure.
So yeah, I think probably small.
Interesting.
Yeah.
Do you use, when valuing football players, do you use like cash return investments? Or, do you strictly look at comparable players, or what do you, when you value players?
No. Good question. I mean, I don't know whether you could. I mean, I suppose you could look at the likely life of the player and yeah, but no, we don't. What we do is we feel that we have an edge on understanding what the team needs, and I suppose where there's value in the market. I mean, it's difficult to explain, but basically, when you think there's someone who, so actually one way to think about it is there are certain leagues. So the Premier League is the best league, arguably, along with La Liga in the world. You'll then have a raft of leagues which are a lot lower, but some of those leagues may be almost comparable, or for certain players, certain position. So if you took the Eredivisie, for example, in Holland, it's clearly at least one level down from the Prem, but it may be that the top teams in Eredivisie, they've got some players that would be so understanding the relative kind of merit of one league against another, and therefore because you only know how good a player is based on the other players he's playing against. So you know, a player can look fantastic if they're playing in Argentina 3, but they're playing a load of rubbish, so it doesn't help. So understanding what, you know, how good they are given the kind of competition they're facing is something I think we're good at. But it's not easy. It's yeah, and knowing, I suppose, understanding the talent of a player in a particular role. So some people look at a player like a holding midfielder. Guy picks the ball up, plays a sideways pass, so his pass completion rate's very, very high. We look at that and think, what a waste of time, because you know, you need to be moving forward, and in the Premier League, if you're playing sideways, at some point, because of the high press of a lot of the teams, you're going to lose the ball and you'll be exposed. So understanding what's important is
Yeah, good. So it brings us to an end. Thank you so much. It was a fascinating talk. Thank you for your insights into the media industry,
That's pleasure.
into your career. Very fascinating. And of course into football.
Yeah.
So thank you so much. Thank you for your
Thank you.
for your thinking. Thank you.